Welcome to the Broken Pie Chart podcast, episode 368. I'm your host, Derek Moore. With me once again, Shane Skinner, Mike Snyder, or Mike Snyder and Shane Skinner, whichever order you prefer. All right, so we said at our beginning of the year, our market forecast or market 2026 market preview, there was a couple risks in markets. And of course, there's always geopolitical risk. We also talked about how in midterm years, this is kind of how it happens, where markets are a little bit more sideways to down. A lot of times they're down. And then towards the back half of the year, they start to pick up. That's historically. I mean, who knows what's going to happen this time. So we have a midterm year. And there's data that says after the midterms, what is it, a year after the midterms, going back to the 60s, the market has, quote unquote, never been lower. The other thing we mentioned was the dollar. And I don't remember the level I specifically cited, but I said, if the dollar is back over 100, that's actually a headwind for equities. And the reason why it's a headwind for equities is because multinational companies, strong dollar means that earnings take a hit because you report the earnings in dollars. If you earn overseas, you report in dollars. You're reporting in less dollars. When the dollar was strong, kind of that 2021-ish period, 2022 into 23, companies would report and they would say, but for the strong dollar, we would have had EPS of this. And they had footnotes that said, well, if we adjust for a normal dollar, our earnings would have been X% higher and all that stuff. And then, of course, there is energy. We talked about it in our prediction show. We said, what would you buy if you were contrarian? And we said, I think we all agreed, like nobody wants energy right now. Nobody. And we even question, is energy the contrarian play here? And could energy do this year what gold did last year? So we didn't necessarily trade on any of those things. But let's start with the dollar. And the dollar crested 100 today. Shane, I think you had sent something out, just some of the numbers for the week. Yeah, dollar back over 100. The 10-year is still pretty...
Picked up a little. Just a little bit.
Well, I mean, the 4.283, that's not a big deal, the 10-year. I don't think the 10-year is reacting that much. I mean, yields are not backing off. They're firming, if anything. And crude is just under 100. So, Shane, I kind of joked around that during Hurricane Katrina, we would have the markets on CNBC, and then you would have a box that said the price of oil. We're sort of back in this dollar oil markets. And right now, it seems like with crude up, with the dollar up, we're having an inverse reaction in market, Shane. And I think that's just the temporary environment or the current regime that we're in. And until the dollar backs off, until crude oil backs off, I think traders are not going to really be buying the equity markets with two hands.
Yeah. I mean, I think that prior to all of this happening, you saw rotation going on anyways. And I think that what's happening right now, given the variety of things that you just brought up, what's going on geopolitically, I think you're right. I think you nailed it. People aren't coming in with both hands willing to buy stock. That doesn't mean people aren't buying right now. But the market seems a little less certain about what's going on. I think that the moment that some clarity is provided on a couple of these situations we're in, there's the potential for, risk appetite to pick back up, and we might see some more inflows. But, this is the first time in a while oil's been around 100, right? I mean, I think we were there a couple of years ago, right? Back in, was it 2022? I think we broke, that was the last time.
22 it went negative. Wasn't it negative? Or no, that was 2020 it went negative.
20 it went negative, and then I think we hit it's 120-ish roughly, give or take, right around there, back in 22. So, this argument of like reflation, and that's where I'm looking at more. It's like the dollar, oil, inflation. I don't think anybody knows yet what's going on or what's coming.
Mike, the prevailing narrative from April on was the dollar was going to keep going down. Like the U.S. is done. The reserve currency is done. That's going down. So that's apparently I don't know if we had 29 and a 30 leading economists say that, like 29 and a 30 leading economists said we'd be in a recession in 23. That never happened. But I guess the other thing too is we got to talk about volatility. VIX, VVIX, they are elevated, which means options premiums are elevated. And it also means that it's setting up. So if we get any abatement in volatility, in theory, market makers should have to be taking off some of their hedges or their shorts, buying longs. But, VVIX today was above 130 again. VIX closed 27.19. I think the high, we had a high VIX of 35. It's interesting, though. You look at a chart of the VIX, and the VIX is very different than equities or indexes. And you'd say, well, we have a series of higher lows. So the question is, Mike, do we see higher vol, or normally we see a VIX or we see a VVIX certainly go above that 125, 130. I mean, we hit 140 in VVIX, kind of came off, it came back up. Are we in a regime right now that volatility this is what we got for the next couple of weeks?
Sort of what it looks like. It looks like volatility could stay elevated, but not really. I mean, of course it could, but the way it looks right now is that, it looks like it could stay elevated, maybe not spike to where it was in, end of March or April of last year, but stay in these mid to high 20s in terms of the VIX. And you've sort of seen like a more orderly, slow sell-off, I think, which is sort of in line with the VIX being high, but not, nothing crazy, right? Like the market really hasn't had that big down day yet. It's just sort of slowly been selling off, which I think is exactly in line with how the VIX has been moving. It's elevated, but it really hasn't, it's not 40 plus, 50 plus, where the market's down multiple percentages on huge volume in one day. That sort of seems like where it's setting up. I think the market doesn't want to get in the way of a quick fix in terms of oil selling off again and the market just spiking. And so it sort of seems like it's a waiting game right now.
We're 5.25% off the all-time high, if my math is right. So for a while we said, we're still within 2% of an all-time high. We're still within 3%. 10%, as Peter Lynch famously said, you get a 10% decline every 2 years. He said that in 1994. So would it surprise me if we went down another 4.75 to get down to 10% down? I don't think so. And if you're a long-term investor, you shouldn't care. You really shouldn't. And a lot of stuff that we do, we've got hedges in portfolios or buffers. I mean, when we talk to advisors and their clients, kind of our message is, well, this is why you're hedged, in case you're not trying to time the market. So I would agree, though, it's a little bit orderly. It's frustrating, I think, for people when you see a sequence of down days. But I think you're right. I mean, there really hasn't been that ultimate panic. On the weekends, like if you look at the futures where they open up on Sundays, and people could trade the futures on Sundays when they open. They open 3 or 6 Eastern, right? 5 Eastern. I always do the conversion.
I'm looking at my computer at 5
But those are the ones where you saw, kind of a big down day, and then they abated coming into the open. So, yeah, I mean, we haven't seen a 3% down day. We haven't seen anything like that. Have we seen 2% down days? I don't think it stuck 2%, Shane, did it?
No, we were technically down, I think, at least in the NASDAQ over 3% Sunday night this week.
Shane, you there?
Yeah, can you hear me?
Yeah, we may have lost Shane.
No,
He's speechless.
I'll step in. No, we have not seen a 2% down day stick.
Yeah, so we haven't seen that. We haven't seen that yet. So then you ask, take out the geopolitical stuff, Mike. Take out everything else that's going on, and I would say, if this was just a normal, regular midterm year, Mike, would you even think this is anything? It's just like, this happens. The market rallied up. It's taking a breather, right?
Yeah, it's sort of, I don't know, getting a little tired maybe, and there's not the excitement drawing buyers in at the moment. This would be totally normal without the geopolitical events we have going on. Like a 5% pullback after how the market's performed the last couple of years really isn't anything substantial. I mean, it's a little bit above in terms of the S&P, above its 200-day moving average right now. So it's not like it's had this crazy sell-off. It just hasn't, the market's been sideways. It was sideways for a bit, and now it's down, like you said, about 5% off its high. So
it's really a multiple contraction. Continues to be, we're under 21 times forward earnings now. Forward earnings have not gone down. It looks like 317.05, which would be a growth rate of 14.17%. Analyst forecast next 12 months. The numbers, I haven't factored in today's close, but it was under 21 times. It was like 20.9 forward 12-month earnings. So at one point we were 23. So I just want to repeat this. Earnings estimates have gone up. The market has pulled back because the forward multiple, how many times future forward 12-month analyst expected returns, it's gone from 23 to just under 21. And that may not seem like a lot, but when your estimate is $317 a share and you pull back a 2 multiple points, and it wasn't 317, it was actually lower. The estimates keep going up. I mean, that's why you kind of pulled back where we have. So sales forecast still good. Now those can change. And Shane, you mentioned earlier, I mean, I think PCE came out today. I believe it was an overreaction on PCE. It's still, 2.8, which is not crazy. I think it was up 0.1% month over month. It met the analyst expectation, the estimated numbers. I don't think there's any surprise here. People seem to be pointing to this like it's the end of the world. We've been above 2% for a long time. The other thing is the GDP numbers. I think GDP was revised down for Q4. So, Shane, it's kind of like, what does the market want? Okay, does the market want GDP to go negative so that they have to lower rates? Do they want inflation to come down because it's a sign the economy is weakening so they can lower rates? Like, Shane, I think Powell's gone in May. He's done as the chair, right? Somebody's coming in who's going to lower rates. I'm sorry, but that's just what I believe. Like, these people are not going to come in and not lower rates.
Yeah, I mean, you would think, and where I'm actually wondering if the new Fed chair comes in, does one rate cut to throw a bone to the crowd that's been asking for one for a while, and they don't rate cut again this year. I think this all depends on a multitude of things. I think the VIX is going to remain elevated. There have been periods where the market has traded for prolonged amounts of time with the VIX elevated over 20. I think you saw that 21, 22, 23. There were bouts of it. I don't think it's that big of a surprise that vol is sort of elevated given a multitude of uncertainties going on. Everybody's still feeling out the AI thing. It feels like you've got the private credit stuff going on that's starting to make rumbles across the street. You've got this oil situation and what's going on with the Middle East. So I just think that right now the market is really, like, as soon as something good comes out about one of these things, I think the market's very quick to go, okay, that's great, but we've still got this like smorgasbord of a few other things that we would like to see a little more certainty with, or maybe some resolve here. Who knows what's going to happen? But I one thing that does interest me or intrigue me, we talked a couple weeks ago, right, about skew and how skew on the S&P 500 right now, we're seeing like a little bit more demand than normal for puts versus calls. It was at a 52-week high. Since then, we've backed off of that high quite a bit. And yet the market stayed pretty much flat on this week. I think we're down on the week technically, but where we closed today is basically where we opened Monday morning. So barring the movement in futures overnight, Sunday night, you closed flat.
You're talking about the VIX now, right? Or skew. Yeah, okay.
Yeah. Well, I'm talking the S&P did that, right? And the VIX kind of did the same thing. I think the VIX is technically up on the week, but again, most of that came from Sunday night. And then you saw that rally Monday morning. Where I'm going with this is you've had the drop off in skew and demand for S&P 500 puts relative to the calls 30 days out. And yet the market's not gone back up really. And vol has stayed elevated. So what I'm intrigued by and what I'm, I guess, kind of concerned of is, did a bunch of people come in the past couple weeks and hedge really aggressively? And that sort of contribute to this downward movement. Those hedges get monetized, and then certainty really hasn't returned to the market yet. So what if there comes, a second bout of more hedging coming in, right? More people, sending that skew back upwards again. To me, that's when, especially with us trading right around the 200-day, like, I think that's where the big fear lies here is does the market return to buying a bunch of hedges and or, people selling?
There's something important to remember too, and that's the VIX is not a tradable product. And the VIX is made up of, and I'm just going to do the basic kind of back of the napkin here. If an option in the S&P 500, you go up and down the chain and, 30 days out, all that stuff. The ones included in the VIX are ones that have a bid. So if it's 5 cents to 10 cents, that's included. And if you have no bid, those aren't included. That's a general statement, right? And when you see skew, it doesn't mean that stuff is traded, but it may, it's like more of the ones very far down have a bid. And that's one of the reasons why I think, you saw that skew. And does that mean that people are willing to buy very, very deep out of the money options? And by having a bid, it means you can sell at a nickel or you can sell at a dime or you can, so those types of things.
Right. You're not talking about buying an at the money put because you think it's going to go down, 100 points this week.
But you see what I'm saying, though, like skew.
Going to the tail end of the expected distribution for that time period, and you're buying that tail end, thinking that it's underpriced, right?
Yeah. I mean, you can look at a chart of skew and you can see what the skew is.
Yeah. And just because it goes up or down, that doesn't mean we're going to go up or down, right, in the actual market.
No, in fact, I would say sometimes when volatility is like skew is dropping, as you said, partly because the relationship between at the money and out of the money. But all right, another thing I want to talk about, Bloomberg, Michael McDonough, he put something out on Twitter. I haven't tried it yet on Bloomberg myself, but he was nice enough to post. They launched near real-time crossing data for the Strait of Hormuz. Like, how cool is this? Okay, so 30-minute visibility into the world's most critical oil choke point. Data powered by real-time AIS transponder data. I don't know what that is, but it sounds really cool, and I love it. So they monitor inbound and outbound movements, and where the audience can't see this, but I'll just kind of describe what I'm looking at. And it's Tankers 1. So this is intraday ship crossing, 24-hour rolling 30-minute update, Strait of Hormuz by vessel count. So apparently in the last 30 minutes, one tanker and zero dry cargo ships. if you look before all these happenings happened, it was anywhere between, let's say, if you look at the tops of the white lines there, the tankers, probably 35 ships going through there. So, yeah, I mean, this to me right now, and somebody on Bloomberg, I saw this online. I can't remember if I have the link to it or not, but he actually took out a physical map and he was showing where the ships have to go, and the fact a lot of ships are stuck north of where they can't get out of the Strait of Hormuz because they can't pass the point in between. Iran has a chokehold on it. So you got these ships that are stuck, and they can't get out, so they can't deliver the oil, and ships can't really go in to some of the countries. So yeah, like Mike, I know you're a big fan of boats and ships. You have you go to the pond and you have you have your little plastic boat you put in the water. I don't know if you do that or not, but like this, no. Are we really? We're watching boats now. Essentially, is what we're doing.
That's where we're at. I mean, oil is driving everything. Like we were talking earlier, take the geopolitical and oil events out of this market. I mean, you can't right now. Oil and oil prices is driving everything. We just talked about earnings haven't come down. They've actually gone up. Maybe this sell-off in the market, it's like as oil goes up, the market's just slowly discounting or pricing in expectations of lower margins and earnings coming in. So this chart is, this chart we're looking at of boats leaving is sort of why oil is going up, which is affecting everything.
Why does it always come back to boats, Derek? I feel like anytime there's any real vol going on, we're looking at shipping containers or boats.
Well, you guys weren't around, but I got made fun of in, 2021 when I was like, I'm pulling up charts of 40-foot Drury, container ship cost per box. Like if you think about a container, it's what you see going by in a train car. And it's a 40-foot box, and these are standard across. And I started looking at the charts of the rates. And I'm like, that's interesting. These are going up. I think we're going to have inflation. And when I say they were going up, I think they were $1,500 up, the cost to fill one of those boxes. And at one point, I think they went up to like 10, 15, even higher if you didn't have a contract, if you just stepped up. That's the story of Tracy Alloway. She was doing a story trying to ship a teddy bear in a container box. And at some point, probably Bloomberg was like, we're not spending this much money to ship your teddy bear. But she kept getting delayed. They're like, nope, can't get this one, can't get this one. So yeah, Shane, like sometimes container rates matter.
Yeah.
And it also takes boats out of service. So these boats that are stuck, this is a supply thing, and supply shocks have impacts on the markets.
Absolutely. I mean, isn't this a masterclass in getting to see how economies and the globe is so interconnected, and that most people think of industries and the economy. I think we like to compartmentalize and think of them as this big mix of a bunch of small things. And for the most part it is. But at the end of the day, stuff like oil, it's sort of the life force of a lot of everything else within the economy.
Well, oil's in everything too.
Yeah.
I mean, oil is part of so much stuff. I did pull, let me see when this is as of. What is this as of? Okay, this is as of March 12th. So far, it looks like it's off the bottom, but container shipping rates, and this isn't necessarily for oil. Containers, it's really more goods that come through. But here's your chart. You see back 2021 when they crested 10,000 per 40-foot box. And it's been, rather sanguine for a bit, but 2122 is the latest. So this is something I'll watch. People can make fun of me if they want, but I like watching non-obvious things to give obvious answers. And sometimes it's stuff, that not everybody's thinking about that matters. So, all right. What do we have next week? So there's a Fed meeting, right? Our friends at the Fed are meeting. Is that right, Mike?
That's right. FOMC next week.
What is there, like a 0% chance of a Fed cut or rise, or rate rise?
I think it's as close to zero as it can be.
Do they do anything though with the balance sheet? So do they actually draw down any sort of purchases? Do they announce they're doing something with MBS bonds, mortgage-backed securities? I mean, is there anything they do, or they just meet and say, based upon the data, we're data dependent, blah, 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 and then do his press conference? What do you think?
That's sort of how I see it going. I think that they're going to get a lot of questions on oil, and they're going to say, we don't see that in the numbers yet. And that's going to take up the majority of the conference.
When is his last day? Assuming he he could stay on the board. He just wouldn't be the Fed chair.
Let me see. I forget. I think it's in May or June.
I think it's May. And
May 15th.
May 15th. Okay.
Yep.
So they have a meeting on the 18th next week, and then they have one April 29th, and then June 17th. So he's got 2 more meetings left. So yeah, there's no chance he's going to lower rates.
Yeah, I mean, I don't think so. And, it's really weird. I don't know if you guys have paid much attention, but like this past 7 to 14 days, we've basically seen the expectations of rate cuts for the year of 2026 fluctuate from basically like half a rate cut to 2.5, something like that. It's been really crazy with everything going on. And so I don't know. I think that this week or next week, this is the first FOMC in a while where there's been a lot more going on than just the usual, typical, normal business, if you will. And so, with tariffs no longer nearly as big in focus, I think, in this situation as the situation is with oil and, what's going on in the Middle East, I just don't know how Powell comes in dovish. And I worry, I don't think he's trying to upset the market, but I worry he's going to come in hawkish. He's going to point out a couple of things or talk about a few things that the market's not necessarily thrilled about. And I worry that has the potential to ruffle some feathers. Can
I tell you on interest rates, I'm looking at swap rates, which they go out a little further than the Fed funds futures, but swap rates, I mean, the low swap rate is 3-year 3.43. But then I look at 3 years out, call it it's bid 3.41, 3.46. So right around there. I mean, my point of bringing this up is you look a week out, the swap rates, you look at a year, 2 years, 4 years, 5 years. I mean, 5 years out, they're pretty much, say anywhere from 3.45 to 3.6 something. And I bring that up because you're right, Shane, like it's going out to Jan 27. Actually, Mike, I'll ask you this. Like Jan 27 has just under 100% chance that it will be a 25% cut, about a 91% probability the December of 26 that we'll have one rate cut. I still don't buy it, Mike. Like these people are coming in to lower rates.
So you think there's going to be more than one cut?
I mean, the effective rate right now is 3.64. Would it surprise me if we get 50 basis points of cuts and we go to 3.25 target? 3 to 3.25? I mean, the target rate's 3.75 right now. So,
I mean, so you don't buy that oil is going to be a headwind for them to cut. is kind of
I
what
don't think
you're
interest
saying.
rates matter though for oil. I mean, don't you think oil doesn't? Interest rates going up or down isn't it? This is clearly a supply shock, right?
Yes. But if it stays elevated long enough, I mean, at some point, doesn't that drive inflation higher?
Okay, fair point. But do interest rates matter at that point? Like, is interest rates the problem? We had low rates for 10 years after 2008, and we had no inflation.
No, it would be a reaction. It would not be, yes, it would not be we have to raise rates because we need to fix oil. Interest rates will not help that. Right.
Jay used to say, Mike, that the market doesn't necessarily need interest rate cuts. What it needs is the Fed to be considering interest rate cuts or people thinking they're on the horizon. They don't actually have to do it, though.
Yeah. I mean, if the market's just constantly pricing in 2 cuts and they never do it, it's an interesting way to think about it. Because when the Fed cuts, it's almost always priced in, right? So, I mean, I think at a certain point, if the market's expecting a rate cut on a certain date and it doesn't happen, that may upset the markets. But if it's then pricing in, okay, but in 6 months it will happen, the market's going to say, okay, it's going to happen eventually.
I mean, what the problem with the argument, not yours, I'm saying what I'm seeing people talking about on CNBC or Bloomberg is this idea of we can't have rate cuts because we have inflation. Well, if we do have inflation and the economy is not doing well, doesn't that mean we get a rate cut anyway? That's the thing. Like, they seem to be thinking the economy is going to be really strong even if oil goes to 200 and then other input costs go up as well. And I think if that happens, they would have to lower rates because things would not go well. That's what I'm saying.
Right. You have to consider the economy and GDP before you consider inflation is kind of what you're saying.
Yeah. Like Shane, the other point, I think GDP is everything that's sort of the final stage product, new products that are here in the US. If something's made in Canada, then it would be part of Canada's GDP. If something's made in the US, it's part of, if we import maple syrup from Canada, or we import Connor McDavid from the Oilers, well, that's not really part of GDP, but you get what I'm saying. If we import a bottle of maple syrup from Canada, that's in their GDP, not ours, which is one of the reshoring arguments because you build it here. So given what's going on, defense and different stuff that you need for conflicts, like, doesn't that mean that we're going to have some manufacturing of those types of items? And if they're manufactured here, that juices GDP.
Yeah, I don't necessarily disagree with that. I think in the last couple GDP reports, I think it's been evident that growth is coming from basically like the things we need: healthcare, staples, housing, rent, things like that. And then the data centers. And this is where I'm worried. You've got this potential energy crisis situation thing looming, right? And I'm with you. I don't think oil being in the 80s or 90s is necessarily the end all be all, and that we're going to just immediately collapse into some massive recession because oil's trading up closer to 100 than it is 50. With that being said, when a good chunk of what our real growth is coming from, as of late, it's been a lot of this AI data center stuff. And that's what scares me is if oil stays elevated and a good chunk of where future growth and what we seem to be witnessing a lot of investment going into, it could whack that. I agree with you on the defense thing, though. I think that there was something said about some of these defense companies are going to be ramping up production of things. I think this just all depends on how long the strait stays closed and how long, the military continues to be involved. And that's, I mean, who knows, right? It could end tomorrow. It could be a year. I don't know.
All right. Let's talk a little bit about PCE and really where the hot spots were with PCE. I look at durable goods. Not really too much going on there. If I look at housing, yeah, I mean, housing, what was housing? Yeah, I mean, housing has been on a downward trajectory. And if I just look at US PCE, I mean, I don't know. It doesn't look crazy. It really doesn't. And I know it's still above 2%, but I remind people, like, when is it really just that 2%? So I think what's going to happen though is, CPI is going to be high. So when we close March, let's assume oil's right around where it is now. So fuel costs are going to be higher. So that's going to be a surprise. The core may not surprise as much. And when I say surprise, maybe analysts are going to be too high on the estimates, but I don't know. Financial services and healthcare were two of the ones that were the problem in PCE household consumption. So yeah, healthcare is going up, and then financial services.
But do you think those are necessarily like do you think that that's indicative of a really strong economy when you're seeing a majority of growth coming from almost like staples or things that are just like a given that people are going to need that? I'm not trying to, play devil's advocate here, but I have to look at look further back, but I don't think a ton of growth over the past decade or two stemmed from healthcare. And maybe I'm wrong.
No, I think healthcare has been growing. I mean, think about the cost of healthcare and the prices.
Naturally goes up, right?
Yeah, those are, I mean, housing is usually laggy. It lags. Everybody knew it was going up, but it didn't show in the data. And then it did, and it's still probably artificially high, the year-over-year growth in housing prices. But yeah, I mean, the PCE is the Fed's preferred gauge, but it wasn't out of line with expectations, and it was 0.1% month over month. Like, it wasn't a lot. So yeah, I don't know. All right. Anybody coming out with who's earnings next week? Who's Mike? Any companies reporting earnings next week we need to be aware of?
Let's see. Shane, I think you said Cisco. Is that right?
Oh, you know what? I had that. Oracle reported this week. I don't know if Cisco's reporting next week. Sorry. My brain, for some reason, Oracle and Cisco are the same ticker. I don't know why. It's the only tickers I do that with.
We have Dollar Tree on Monday.
That's exciting. I think we have
it's really not.
Three of those within a 10-mile radius.
Come on. Is that the dollar store, but nothing is $1 anymore?
Yeah.
Or is it the 99-cent store?
$5.
Yeah. Yeah, I don't know about those.
Did you set Mike up for failure? Is this and I contributed to that too. Is this the week where nobody reports?
No. Well, let me look. I have like 17 charts up. I didn't have that one up. So let me pull that. There's always, who comes in late? We know NVIDIA's late, but they already reported. And then you kind of look and you say, well, who else is coming out next week? And
Micron on Wednesday.
Okay.
All right. So Micron matters again. That's hilarious to me.
Memory.
Just because that was a stock in the early 90s that we traded. I've said that before. It's like, it's so funny that one is making a run again. So if I look at, so Micron, let's look at Micron's options. I'm looking at one other source for the, okay, so FedEx next week.
Yep.
Asco the transports goes the market sometimes. DocuSign is next week. General Mills, so a consumer staple. Micron.
Watch your Lululemon. That's a good consumer one.
Nike.
Yep.
Nike. Lululemon hasn't done well in a while, though.
I think the Ulta and what's the other one sometimes are good to watch. And you're right, Lulu's kind of lagged. Those are sometimes good to watch. The beauty products. My wife works in that space, and it's usually recession proof. So when you see pullbacks in there, maybe that's.
I don't know. I threw out an Ulta coupon one time, and my wife was not happy with it. You get those in the mail all the time, and I'm like, what is this? I just threw it out. And she asked me, hey, do we get an Ulta coupon this week? I'm like, no. No.
It would be the one you throw out, right? It would be the one.
I don't throw them out anymore. Doesn't matter how many we get. I display them prominently on the counter so my wife can use those. Yeah. All right. So Micron is an interesting one because it's back in favor. And so if I go to the options chain on Micron, and I look, and let's see what the volatility is. You said it's what, Wednesday? Is that right?
Yes.
Wednesday after the close. So we gotta look at either Thursday or Friday. So it's going to be Friday the 20th. There's the options we're going to look at here. And it closed today. I don't know. Is it up today in a down market? Okay, so 426.13. So yeah, I mean, let's look at these options and see what the market is expecting. I'll use the, 425, 427s. And the implied volatility right now is, 94. So let's do the math for all the home gamers. A volatility of 94 divided by 15.875. So 5.92% right now is sort of the 1 day expected standard deviation, up or down. And what do we got? That's 5 trading days, right? Or 4 trading days. So 5.9 to the square root of what? 4 is what? Like a 9.7% between now and then. Did I do that right? Something like that.
Sounds right.
It's actually, sorry, I did it wrong. It's the square root of 4.
He tricked us, Mike.
Times 5.9. 11.8. All right. Did it live. 11.8. So basically, between now and Friday, it's like, or through the end of Thursday, it's roughly a 12% expected 1 standard deviation move. So, yeah, like that's pretty high implied volatility. That probably goes higher by Tuesday. Yes, thanks, Shane. That was Bill O'Reilly we'll do a live. That's right. I mean, to me, so it's pricing in a pretty big move. Let's look at the straddle. So, I mean, it's really the strangle. So you buy the 425 put at, we'll call it $22, and then you buy the 427.50 call. What is that? So it's like $44. So it's to break even, you need a move of $44 one way or another from where it is right now. And what that means is 382, or it's got to go to 470. 382 to 470. If it's somewhere in there and you buy the strangle, the strangle is not equal strikes, but the one below and the one above. So yeah, I mean, it's pretty much telling you it's over a 10% move. It's about an 11% move right now. So, Mike, are you buying the strangle or selling the strangle?
As always, it seems like it's priced pretty well. I mean, this stock has held up. Like you said, it was up 5% today in a down market. Yeah, that feels right. About 10%.
All right. So if you buy the straddle and it moves less than that, you make nothing. And you might only make a penny if it moves, 12%, right? So
if I have to do one, I'm selling it.
Okay, you're selling it. Okay.
Yes.
All right. By the way, home gamers, don't do this. Like, this is the most dangerous trade.
Yes.
And I say that with a smile, right? Because this is a volatility trade. And if you short it, you have unlimited risk to the upside. If you're short a call, you have unlimited risk down to zero. So yeah, you got a bunch of risk. So you're going to sell the straddle in hypothetical play terms here. Shane, what are you doing? You buying it or selling the straddle?
Oh, sell
the strangle. Sorry.
Sell the strangle, both hands. And if I'm really worried about the risk, Derek.
Shane, you're speechless again, right?
Can you hear me?
All right, I'll go back to me then. I'm a seller of the strangle here too, Mike. I think I'm selling the strangle. So yeah, like this feels like I wonder if it's going to be like Nvidia, where they come out with earnings and then they come back and it really didn't move as much as people thought they would. But you've got heightened volatility in the market already. Plus, you have an earnings release. I tend to agree with you, which means we'll probably both be wrong, right?
Probably.
Yeah.
I mean, so on the long end, your break even is, what'd you say? It's like 448. Is that right? So that's
more. 470, I think, right? 44 points plus 426. Yeah.
470. So yeah, that's above the high. And on the short end, you got the, what is this? You got the 50-day at 387.
Yeah, so your 382 is below the 50-day.
Can you guys hear me?
Yeah, we can now.
Oh,
yeah,
I'm back.
I know you were speechless.
I know. I was just astounded.
I was just asking. Both of us are sellers of the strangle.
Listen, I tried to get cute with it, and that's why my mic wouldn't work. I'm going to sell the strangle, but out of a fear of it breaking down or running up to 500, I'm going to say we buy a call and buy a put 10 points above and below the strangle we're selling to turn it into a condor. I don't want that unlimited risk.
All right. Actually, an iron condor. To be specific. Yeah. All right. Well, we'll see what happens. But yeah, I mean, Micron's an interesting one because it all goes back to, it triangulates back to the servers, the memory, like all these things, AI. And that's kind of where we're at.
Derek, do you wonder if like the earnings call and the guidance is way more important right now on a name like this? Of course, the numbers are great. These are some of the best numbers they've ever posted ever, right? Do you think it's the guidance? Do you think it's, if anything gets brought up with what's going on with oil and stuff and their expectations on how that's going to affect the bottom line, you think that's has the biggest weight here?
You know what? I haven't followed this company since the 90s, so I'm terribly undereducated on them. But you're not wrong. I mean, let's just think about what this company is priced at. What type of growth is the company priced for? And if you look at the earnings estimates and you look at how many times forward earnings over the next 12 months, we talked earlier about the S&P. And, Micron, from what I can tell, it doesn't even look, it looks like this can't be right. I'm in Bloomberg right now, but it says it's trading at roughly just under 10 times forward earnings estimates. That can't be right. Something's off there. Because if it was really only trading at 10 times forward, no,
there's a lot of expectations, or there's a lot of like, at least from what I've seen, maybe you guys have seen elsewhere different, but the big thing around Micron is the memory, and memory seems to be a big thing NVIDIA is making a big deal about right now, because as these chips evolve and get better, they require more memory. Eventually, I would think they try to make a better chip that requires less memory, but I'm not a chip maker, so I don't know if that's even physically possible. But it seems like that's where a ton of the emphasis on like this, and I think we talked about SanDisk prior. It's another one
one from the 90s, yeah.
Right, yeah. 20, 30 years, and all of a sudden memory, it's hot right now because of the sort of expected. I think there's a ton of demand for it.
By the way, I did the calculations myself. I think they're closer to 50 times forward earnings. not 10. So come on, Bloomberg, be better. You're charging enough money. I'll speak to them about that. All right, let's go to recommendations. Shane, what do you got this week?
Oh, I'm going to have to go with Margin Call. Not that I think it's, '08 all over again, but the wife agreed to watch it with me this weekend. So I am so excited to pause this movie every 10 minutes and explain what's going on or what just happened to her.
Do you know I did a companion podcast? It was a solo one where I explained everything that was in that movie. Credit default swaps, all that stuff.
I'm going to have to go look that back up in the archive.
Yeah, I'll have to find it. I did one on The Big Short too. I mean, this is probably back in 2018 or something. So if I find that, I'll put a link to it in the show notes so people can check out both of those. And it's really funny. I haven't checked, but those were some of the biggest historical audience numbers, like cumulative numbers. It was still pretty high up there, which is interesting because people would watch the movie or they'd listen to that or simultaneously. Anyway, but yeah, like what a credit default swap. I explained what that was. And the thing I like about Margin Call, it's like The Big Short was a movie for everybody. Margin Call was one for us.
Yes.
Because they're talking about VAR, value at risk, and they're talking about, it's really the idea when you're doing your risk models and mortgage bonds have never moved more than so many standard deviations, like the probability of it moving as much as it did based on historicals wasn't there. So you do a value at risk calculation and it doesn't seem like there is much risk. So, but what a good cast. I mean, Paul Bettany, he's got a great role as the trader. The two young guys, Demi Moore's in that, Kevin Spacey. Who is the guy? Explain it to me like I'm a 3-year-old or a golden retriever. The English guy.
Oh,
at the table.
He's like one of the best. I don't know him as an actor, but he's one of the best guys in it.
Jeremy Irons.
Yeah. No, the
Jeremy
whole
Irons.
thing. Seeing
Stanley Tucci's in that too.
Yeah, he is, isn't he? It's seeing the interconnectedness and the layers too of like a really big shop like they are. The hierarchy, the channels of communication, and just how that works. Like it really is truly one for us, like you said.
Oh, for sure. And that, The Big Short. The Big Short's a great movie too. That's an adaptation of Michael Lewis's book, The Big Short. It's a great movie, and they actually take time to explain some of the stuff. Like they have actors come on with a little cameo and they do stuff. But Margin Call, it's more one for us. So no, that's a good one. It's always good. So Mike, anything you have for us?
Drive to Survive, new season on Netflix just came out with the start of the F1 season. It's pretty interesting. It's, there was a lot of driver changes and rookies last year, so I'm a few episodes in, but so far so good.
Do you know, we forgot to talk about, well, I did watch the first F1 race. I thought it was good. The new regulations are still, I'm 50-50 on those, but we didn't even talk about the Olympic hockey game, the gold medal game. Like what a tremendous game that was.
Yeah, we didn't. Yeah.
That was kind of sad in a weird spot. So yeah, when it was 3-on-3 and you have McDavid, McKinnon, and I think it was McCarr was out there.
Yep.
McDavid is just unbelievable. He's clearly the best player in the world right now. And McKinnon's pretty good too. And by the way, McCarr is pretty good. And
they may be the 3 best players in the world, those 3.
Do you think? Like, if I'm trying to think who on... Yeah. The U.S. is a little... They have a lot of skill, but they do some of the dirty stuff in the corners better, probably. Yeah, there's a lot of skill. So that was great. I watched the first episode of a new show on HBO Max called Rooster. And I don't know, I was on a plane. I saw it was new. I downloaded it and I checked it out. I'm trying to remember who is all in the cast. Let's see. Steve Carell is in this. So Steve Carell is in it. Pretty funny so far. So it's on my watch list. I'm not ready to commit to a strong recommendation one way or another, but Rooster on HBO Max. But come on, HBO, like just do what Netflix does. I'm not going to stop complaining about this. Just give me all the episodes. Now I got to wait, like 10 weeks to see them all? Not happy with that. Same thing with The Pit. Just give me all the episodes. All right, that's it. I'm off my soapbox. I forget. What did we predict for oil? Mike, I think you said it was 70, right?
I was at 85.
Okay. Shane, what were you?
Was that 125? I think Mike wins via Price is Right rules.
Well, what did I say?
75.
75.
Okay. So closest to the actual. Yeah, Mike, you won. Okay, let's do it again. Where does West Texas Intermediate, WTI, wind up next? Let me give you the current quote on it because let me see where the future ended. 98.71. Where is it next Friday when we're doing the podcast?
I'm sticking with 85, and I'm staying with my VIX of 24.
Okay, I forget our predictions there. Do you guys remember what we said? Well, you said 24, so that's
I was at 24. Yeah.
Shane, what were you?
It's probably 28, 30, somewhere up there.
And I don't even remember. This is how much we like when you don't trade off any of this stuff.
Don't trade these, right? Don't trade these.
Yeah. Oh, it's 27.8. Yeah, so you're pretty close.
108 oil, and a 28 VIX is where I'm at.
Okay. I will go with a 20 VIX and 70 oil again. So
perfect. Someone's going to be right or pretty close.
Is anybody writing these down? I literally didn't even remember what I said.
I'll have to send yours in our chat.
What about the dollar? So spot rate closed today, 100.49. Where's the dollar in a week? Is it above or below 100? Let's just do that.
Below.
Above.
All right, that's it. We did it. See everyone. We'll talk to you next week.